evening and welcome back to our Rex Fuels channel, where we discuss issues and trends facing the oil and gas industry. If you're new to the channel, kindly like, subscribe and share to stay up to date with the current trends. Once again, we have with us Pranav Kant, a veteran of the oil and gas sector and an expert on strategy and marketing. Welcome, sir.
Thank you and welcome to you.
The arrival of the first shower has lightened the mood of many. Do you think this cheer could extend to the crude oil markets?
The showers indeed have really burned up the mood, especially after the hot weather preceding it. So, how the market is going to be reacting, I guess we'll need to wait and see.
Well, I hope it's a positive reaction. My first question to you today is, the US record inflation data and the reintroduction of China lockdowns appears to have paused the crude rally. Do you think this reaction is temporary and the crude rally would continue?
Excellent question, Gina. The US consumer price inflation data reported at 8.6%, 8.7%. So, which is very, very high. When we say very high, it's highest in the last 40 plus years. So that really puts it into perspective. And the consensus view where we tend to agree with is this is likely to further gain ground. So we do not see any immediate easing of the inflation worries as far as the US market is concerned. And this inflation is not only US centric, but across the world. On a data published for 111 countries, US is at the 48th rank, which means there are 47 countries in the world where the inflation is higher than US. So it's a global phenomenon, that's the point. So we need to really be paying very close attention to its impact onto the markets. Now, coming back to the second part of the question, the reintroduction of the China lockdown, yes. And as we have been saying in our previous episodes that we did not anticipate too much of a difference, even when the lockdown were expected to be eased off. And unfortunately, it has taken the turn for the worse in terms of the reintroduction. So China demand scenario would continue to be depressed, also because the China inventory level, even during the lockdown, was very high. They kept building up the inventory. So even in a foreseeable future, in the next couple of weeks, when China were to start easing the lockdown, the impact on the crude oil market, because of their high inventory level, is going to be very gradual and tapered. So these two things, the inflation, US and the global, and the China lockdown, would be very, very bearish for the oil prices. So the net balance of these two factors alone would be bearish for the crude oil prices.
As you said, bearish for the crude oil prices is something to look forward to, I guess, in the coming weeks. My next question to you is, how is the OPEC Plus increase in July and August production quotas likely to impact the supply situation?
Yes, that is a very interesting question again. Thanks. We need to see this OPEC Plus announcement of the increase in the production quotas for the month of July and August in terms of where their actual production is. And their actual production has been far below their agreed quotas. The figure for April was 2.7 million barrels per day below the OPEC Plus agreed quotas. Now, the figure for May, the preliminary figures, appears not to have changed much, which means they are still producing much below their agreed quotas. So the supply situation, the likely impact of this 648,000 barrels per day of the increase in the production quotas, we guess it would not be significant. So, and we again bring the attention of our viewers to our previous episodes where we maintained that the oil market appeared to be pretty evenly balanced in terms of supplies. It's the rerouting of the supplies which is causing the level of complexity and the vagueness in terms of the information getting to the market with a time lag. So we believe the larger interest of OPEC Plus would be to maintain the prices at a relatively elevated level, which is correct. But at the same time, as we discussed in the previous question, the demand destruction because of US inflation, global inflation, Chinese lockdown, and very important part is the forecast, the recent forecast by OECD, lowering the global GDP growth forecast. So we have the World Bank, which is forecasting the lowering of the global GDP growth to 2.9%. We have the OECD forecast, which is at 3%. And we have the IMF forecast, which is at 3.6%. So across the board, all the agencies and the institutions are lowering the GDP growth forecast. So our view is the markets have a significant price risk towards the downside.
Thank you so much for your insights. And thank you for being here today. It was a pleasure to talk to you as usual.
Pleasure. Thank you.
And thank you all for watching. Continue to show support by liking and subscribing to the channel. We'll see you soon.